Wendy. I'm Julie Keys, and I'm thrilled to be here. This is such a timely topic right now, and I'm just really glad that I got to be invited to speak. I do a lot of speaking and teaching and training on the subject of exit planning, and I'm also a consultant, certified exit planner, value growth advisor, and most recently passed the baton on the Exit Planning Institute chapter here in the Twin Cities, but I ran it for 4 years. So you've probably heard about EPI. Kyla and I are going to be presenting on this topic that we feel is super timely, and it's just going to be a high overview, but I think you'll really get a lot out of it. So thanks for having me.
Thanks, Julie. We're glad to have you. And for those of you that don't know me, I'm Kyla Hansen. I'm a partner at JAK. My focus is on the financial statement side of things, like audits, reviews, compilations, all things GAAP, generally accepted accounting principles related. I'm also a certified valuation analyst. So a lot of the succession planning, merger acquisition stuff that happens at JAK, I have a hand in helping with that. I'm also involved in the ESOP world because that is a potential exit strategy as well. So like Julie said, we're going to be pretty high level here. Try and give you a few good takeaways of that you can implement now. We're going to touch on the phases of the sales, common considerations, some of the components that go into exit planning, talk about some of the drivers for your value and ways you can have consultants help you determine your value, and structure of the transaction. And by that, I mean the financing component, the entity structure, and taxation. And then once you get to the end of your exit plan, the life after that. So I'm going to hand it over to Julie to get started on the phases of the sale.
All right. Thanks, Kyla.
Yeah.
So what you're looking at right now is a graphic that was copyrighted by the Exit Planning Institute several years ago when they first started teaching the Certified Exit Planning Advisor credential coursework. And so this is kind of a roadmap that we use as certified exit planners in kind of walking through the process of exit planning with our business owner clients. But before I break this down and explain it to you, I guess I'd just like to ask you, you know, given the fact that all of us have been through quite a lot since the onset of the pandemic, I'm wondering if you've identified what you've really learned through this process. What have you learned about your business? And have you determined where you're the most vulnerable? You know, one of the things that we need to do when we're talking about exit planning is we need to get a business prepared. The owner needs to be prepared, which is one distinction of exit planning, and then the business needs to be prepared, which is another distinction of exit planning. And I think that this pandemic has really revealed some areas where all of us have found ourselves to be vulnerable, which is actually a blessing, because when we discover where we're vulnerable or where we're weak, we have an opportunity to correct it. Maybe it was in an area where we didn't even know we were weak. So I'd like you to just think about that, and then think about the resilience that has come out of this and how much stronger you've all grown, you and your team. These are conversations that I have all the time with my clients because, you know, we're dealing and fielding lots of issues, right? Lots of decision making, sometimes not a whole lot of time to make decisions, but you really have become resilient, you've become stronger, and we're going to talk today about how to capitalize on all the sacrifice and all the hard work that you've put into growing and building this company over all these years. So that front gate is called the Discover Gate. And one of the first things that needs to be determined is, what's the business worth? Okay. Is it important for us to actually do a full-blown valuation or not? And we're not going to get into all the reasons why you would or wouldn't. But I can tell you that if you're already working with Kyla, and if you're not, I would recommend that you do so. But she can certainly help you with figuring out what your business is worth. We really got to know where we're at today before we can figure out where we're going to go. And truthfully, Another key advisor for that front gate is your financial planner. In fact, one of the first questions that your financial planner will ask you when you get together to talk about how am I going to maintain my lifestyle is, what's your business worth? Because generally speaking, your business is most of your nest egg. If you're like most privately held business owners, your business is your nest egg. And if you haven't diversified, now might be a good time. And so having that relationship with that financial advisor is super duper important. And then once we figured out kind of a plan, right, we know what our business is worth now. We kind of know what we need to do to close the gap. And I say close the gap because most of the time there is one. Not always, but for the most part there is. Especially now, I think a lot of business owners have really found themselves in a position where they need to rebuild enterprise value. So you had a value of X prior to the pandemic, but right, things happened, and here you are finding yourself having to rebuild. What are we going to do to rebuild? What's the gap? And then what's my timeline? If I really want to be out in the next 3 to 4 years and I find that I have a gap, then how do I close that gap? And who helps me to determine if I even have one? So then that prepare gate is where we actually are putting together things like strategic plans. And many times business owners that I work with don't have a strategic plan. And now would be a really good time to put one together. Just even if you don't have a full-blown strategic plan, having some good plans in place, objectives, people who are accountable to accomplish them, and timelines, deadlines on them, identifying where you really are strong and where your opportunities are and where you're weak, to safeguard your company so that if something happens again, you're not going to find yourself as vulnerable and you'll be able to weather the storm a little bit better. And then we assemble the proof, and then we figure out what we're going to do next. We've proven that we've got, a going concern that's marketable. We've proven that, we have the capability of going internal and selling to management, or we've proven that we can't and we got to go external. So then we need to make a decision. Are we going to stay or are we going to grow? And if we're going to keep it, then what does that look like? Who's involved? Do we need more management? Do we bring on private equity? Those kinds of things. So this is just, you don't have to memorize this. This is for people like me. But it says there in the graphic that it takes 2 to 6 months. And that's really not that whole prepare gate. That's just for like a 90-day objective usually takes, time to get some of those things done. So, 3 to 6 months to get each objective completed. And the less you've worked on your business, the longer it's going to take. So you can just assume. And so yeah, we talked about the process, the timeline, the owner readiness, the business readiness. Again, this is really all at a high level, and you definitely don't want to DIY. So Kyla, I'll let you go from here.
Okay.
Oh,
you want to touch on the plan statistics you have?
Yeah, actually, I was thinking that the next slide was yours, but yes, so this actually came from the State of Owner Readiness Survey, and I don't know if you're aware of it or not, but the Exit Planning Institute did a survey here in the Twin Cities in 2017, and they polled, it was close to 300 business owners from various industries and various sizes on their exit preparedness, how ready they were or weren't. And 48% said that they had no plan at all. 21% had a written plan, 31% said they had a plan, but it wasn't in writing. So in other words, that means they really had no plan. And the reason why I say that is because I think that not having a plan in writing is pretty problematic. I mean, you could think about that. What would make not having a written plan problematic? What if something happened? Do your shareholders, do your stakeholders, do they know what your wishes are? If you don't have a plan and disaster strikes, there are lots of places where an error could be made, a mistake could be made. Shooting from the hip can cost you a lot of time and money. And so I think it's important for us to know where the rest of the business owners stand in the area. And I got to tell you, the Manufacturers Association just released a survey. I listened, I don't know if any of you were on that, but Enterprise Minnesota did an event about a month ago, maybe not even that long ago. And they polled manufacturers across industries, and found out that these statistics are actually still accurate. We still have that many business owners who haven't started the process. And so we're out to change that, right, Carla?
Right. And, just to piggyback on that, I think when you actually go to write something down, you realize that there are areas you hadn't considered before. So it helps you have a more encompassing plan.
Absolutely. So when we talk about the goals and objectives of a future exit, I'm kind of focusing here on just determining what it is that you really want and what you really need. Like Kyla said, your advisors are going to be able to help you come up with kind of a process of elimination. Like, some companies are going to be candidates for ESOP and some aren't. If we know that that's off the table right away, then we don't need to go any further down that path. If we know that we have a family business and we have family business owners or family business members in the business, it's a possibility that this could be an internal transfer and that we could pass the business on to our family members. If we're not quite sure, but it's a possibility, then that's kind of on the table. Okay. So we're kind of assessing like needs and wants, working with our team, having a good transition team, and identifying, what it is that we really want to do after. I kind of like to call that next act planning. We're going to talk about that a little bit later on in the presentation, but I really like to call it next act because entrepreneurs go on to something else. They don't sit in a rocking chair and knit. It's just not, we're not wired for it. And I've been one my whole life, so I know that. One of the places where we really get stuck and really get burned, though, is not having a contingency plan. And again, there's a lot to that conversation, but let's just say that risk mitigation is bigger than ever right now. Huge that it needs to be. It really does need to be focused on, not just from a legal standpoint, but a financial standpoint. I mean, think about the areas that came up since the pandemic occurred, where you found yourself at greater risk than you knew, or that you maybe have been putting off. Okay. So that's what we're talking about. Like, if something happened to you, or say, for instance, you're at a place where you know that you need to get the process started, but you really don't want to tell anybody. I'm thinking of a client, and his name is John. And John wanted to work with me, and we've been working together for several years now. But when we first started working together, he didn't want anybody in the company to know that we were working together. And I just said, well, John, you're kind of getting of the age where people are starting to wonder anyway. And they might even get to a point where they're concerned about their job security because they haven't heard about any kind of succession plan that you would have. And so when I convinced him of that after a few months of working together, and he did tell them, we are working on this, we're not sure when it's going to happen, but we are making progress, everyone was so relieved. Okay. Mm-hmm. And so think about that. I could say a lot more about shareholders and generational transfer, and we don't have time, but those are all the considerations when it comes to like, who's going to be involved and who's going to be a part of the decision-making process. And then as far as strategic planning, having an action plan, I know I talked about that a little bit before, but really that has to do with making sure that the business is ready. And it's like, if the business isn't ready, it isn't going to be transferable. And if it's not transferable, the deal's going to derail. So I don't care if you hire an investment banker or a business broker. If whoever the acquirer, prospects are out there, take a look under the hood and find that things are just not well oiled, they're not going to make an offer. Or if they do, it isn't going to be a very good one. So one of the things that we talk about in terms of getting the business ready is making sure that we have a really strong culture. And if there's a time that we ever need to have really good, strong culture and employee engagement, it's now, right? So if you're not really sure and you haven't had any time that you've spent on like articulating what it is, ask your employees, what do you like about working here? Ask your best and brightest employees. What is it that you love about working here? Why do you get up in the morning and come to work every day? What are we doing right? Why do you like it here? And when you hear those answers, and especially the ones that overlap, that are like the same and they're repeated, that's your culture. That's what you've established. That's what you've grown. And so it's okay to expand on that and use it as a tool to recruit, to grow more cohesion internally. Kyla's going to talk about human resources and management and things like that too, but just think about your culture and spend a little time on that.
Yeah, so, just in regards to human resources best practices, I mean, obviously from the title, there are best practices out there. Take a look and see what you're doing. Do you have employee files with I-9s? Do you have regular reviews, an onboarding process, and a strong management team? And do you have employment agreements or bonus arrangements set up with them? Because ultimately the team is part of what you're selling. You're selling a business and they help run it. So everything you can do on the front end to protect that asset of your team will pay off in the long run. And on the financial statement side of things, there are things you can do that are best practices on the front end to help set you up for the transition. First of all, and the most basic, is does your balance sheet or your internal financials have accounts receivable and accounts payable on it? We call that accrual basis, meaning your customer owes you something, so there's a receivable. You owe somebody else, so there's a payable. And the reason that's the best practice is that really tells you how you're doing, what your bottom line really is. And if you're looking at it on a cash basis, you may miss some of that. So a step beyond that is I like to recommend starting to do compiled financial statements. So go to a CPA, have them take a look at it, see if they are in compliance with GAAP, generally accepted accounting principles. And start to just get you on the track to have reliable financial history behind you that others can rely on. A step up from that is a review where we ask questions and do more analytics. Sometimes that pops out things that should be on your financials but aren't. So it's good to know that now. An example is paid time off. Maybe you allow your employees to have PTO, well, that's a liability you need on your books, and it's better to have it there now than be surprised in the end when they're changing your income stream because you have expenses that weren't recognized. Step up from that is an audit. It's like 2.5 times the fees. It definitely has a place in this whole transaction, depending on who's buying your company. But just know there are different levels of service. I try to target my clients to a review by the time they're looking to exit, and if at that point an audit is needed, we can do that. Another key metric that you should keep your eye on over the course of time is your EBITDA, and what that is your earnings before interest, taxes, depreciation, amortization. So that's looking at what is your company actually cash flowing. So company operations, let's ignore the non-cash items of depreciation and amortization and take away the financing components that you have. And typically this is one of the metrics that you use to figure out a value of the company. So I like to track that across time just to see high level how things are going. Another best practice is do budgets, cash flow projections. These are things that the buyer would want to see anyway, and it's just good practices to do it. And over time, I like to flag things that I call normalizing adjustments because it's easier to think about them as you go. An example would be something unusual, infrequent, something you want to highlight and not forget about when people start asking about your historical financials. Like maybe you got a bad run of paint from your vendor and you had to do all this rework. Put it in a different account. If you're getting issued financials on the back schedule, you can have them make a separate bucket. It's just easier to pick it apart going forward. If you can back those types of things out, you'll get more value for your company. And also, when you're preparing to exit, if you're using your company as an ATM, just stop doing that. Get rid of the unnecessary overhead. It's just gonna decrease the profitability of your company, which decreases how much you'll get in the end. For example, that country club membership or wild tickets, or maybe you have extra compensation you're paying out to people, like maybe some family or yourself for tax planning. Just kind of change the expenses to be for what the company really needs. It's my recommendation. And kind of moving into, okay, so what's the company worth? There's, I usually like to first look at what's the floor value, meaning if I look at your balance sheet and you collect all your receivables, you pay all your payables, you sell your equipment, how much money do you have to walk out the door? Your company's worth at least that, but you have a going concern. You have a workforce, you have everything developed, you have customers. There's some intangible there as well. And the way that you value the intangible is by looking at either historical earnings or projections. And a valuation expert can help you, once you have that, assign a value and develop a grand total, including everything on your balance sheet, but the intangibles as well. And some ways to develop the value, as Julie touched on her exit planning overview. To start out, rule of thumb is a good way to see what are you worth about. Is it 200,000 to 400,000, or is it 2 million? It takes like something like EBITDA times a multiple for your industry and can give you a range. It's very high level, but it is helpful. And that's something that JAK can help you with. A step up from that, maybe as you're progressing, and depending upon who you're looking to sell to, what they're wanting to see. But a calculation engagement is one that me and the business owner decide upon the value methods that we'll use. Are we going to value it based on history or based on projections or a combination of both? It's all decided up front, and you, the business owner, get a say in it. The reason I'm highlighting that is the big thing, valuations. They're more expensive. JAK does not offer that. I am qualified to do it, but we've decided to leave that to the experts that do that every day. The valuation, it's the valuator's opinion. They decide the method. They decide all of the rates, even though they'll talk to you, but in the end, it's the valuator's opinion, which is why it's the most costly, but it's also the most credible if you're worried about IRS examination or it holding up in court, things like that. If you're an ESOP, evaluation's required. So it certainly has its place, but there are options. Kept that really high level, but I'll turn it over to get away from accounting. And Julie, do you want to take it from here?
Sure. We'll talk a little bit about marketing. Marketing is a very, very important component of business growth. And unfortunately, most of the companies that I've worked with over the years have had kind of disjointed marketing, not necessarily measured in terms of whether it's working or not. And so then unfortunately, when the chips are kind of down or revenues are down, they'll tend to cut that budget when in fact it should be increased. So if you're finding yourself right now questioning whether your marketing is working, then have a good long conversation with your marketing person, whoever that is internally in your company, and also your marketing firm, whoever it is that you work with on strategy, because strategy right now has to change, right? We're living in a virtual world. And so if you haven't revisited your marketing strategy post, pandemic onset, then now would be a great time to do it. And even if you have to cut back on the expense a little bit, don't ever cut it out, okay? Just make sure that it's working. I like to talk about marketing as, well, it's supposed to be a revenue driver, right? Sales and marketing are really the only things that drive revenue in a business. Marketing is supposed to support sales. It's supposed to drive leads to the sales department, and it's supposed to help us, create more brand awareness for our company. And then sales are supposed to be enhanced by what marketing is able to do for them. They're not the same thing. You can't use sales and marketing interchangeably like there's the same thing, because they're not, but they support each other. And again, they're supposed to drive revenue. where everything else that's in the business actually pulls revenue out, right? That's how we pay the bills, whatever marketing and sales are able to generate for us. And so that brand message and making sure that it's consistent across all your platforms. When you're thinking about exit, your website is your first impression. So if there's a potential acquirer out there who's interested in talking with you and hasn't necessarily made the connection yet with whoever's representing them, with whoever's representing you, they're just kind of looking you over, okay? And your website hasn't been looked at or worked on since the 1990s. It's going to be tough, okay? It's going to be tough. It's going to be tough to actually have them ask for a date. So you want to make sure that your foot forward and your impression that you're giving the world out there is a good one. And then when we talk about successorship, we're talking about, you know, especially if we're going to be transferring this company internally, whether it's to employees or whether it's to family members, just having the conversations ahead of time. So this is all part of exit planning, having those solid conversations, like getting the ball rolling and not shoving it under the rug or waiting until the perfect time, because there never is one. And having someone like me or someone like Kyla who can actually help you facilitate the conversation, because sometimes it's just tough to have. Sometimes you just need to have someone help you get the conversation started, right? Just getting it started. And as far as value drivers go, Kyla's going to be talking about value drivers, but I just wanted to, you know, put my 2 cents in on marketing, because I just truly believe, I mean, even in terms of like your intellectual property, you know, that's part of your marketing, right? Marketing companies don't protect your intellectual property, but they do use it, right? And they will put a focus on it. So even trademarking your company names or your logo or something like that, just to protect what you have, I think, because we are in a global world, I think it's important to do.
Yeah, so to piggyback on that, what Julie was saying, intellectual property, the fact that if you have some, that increases your value. And I'd like to say this slide is from our friends at Sunbelt. I know it's small, but I just love this slide. It's available for download if you go out to Julie's Poised for Exit website. I just think it does a great job of summarizing what can make your company worth more or less. For example, something that's counterintuitive when you start thinking about planning is, if you're the owner, start working yourself out of your job. Make the company need you less, because you're selling, assuming you plan to leave the company with this transaction, you don't want it to need you, because the value drops when you're gone if you're a key person. Another thing that can drive value is having a major customer, major vendor, because that's higher risk for somebody acquiring your company. What if the customer finds a different provider or doesn't like the changeover, or, you know, things can happen to customers. So if you have a huge concentration, try to diversify. That'll increase your value. And for on the vendor side, just having relationships that if there is a problem with the vendor, that you have other options and you're not stuck, certainly. One other thing to touch on in the third column here, the people and process, professional accounting. If you have professional accounting, that also helps your value, because people rely on the numbers, so can rely on them. Also, earnings, if you have steady earnings, that'll help the value because there's less risk. The buyer sees less risk in it there. If you are suddenly growing, and they call it the hockey stick, that can cause some trouble, because the buyer needs to be convinced that that's really going to happen. So you potentially won't get all of that hockey stick. But there is a tool, moving into the deal structure. If you are seeing something like that, there are some tools that can be incorporated, like an earnout. You know, if I meet these numbers on my projection, in year 1, you'll give me 20% of X, or year 2, 10%. You know, there are things you can do if you need to bridge the value in what you think it's worth versus the person buying. And another one could be like an employment agreement, just to help bridge the gap. Something that I recommend doing as well is before you proceed with the sale, like you're ready, distribute things you want to keep, like a truck. You don't want to negotiate on that on the back end. Just take the things that you don't need to be there that you want. And that includes maybe if there's a division you plan on keeping, spin it out now. There are some rules for spin outs on the tax side that if you have a couple years in between, it can benefit you. So just really start thinking about that. Also be aware that there is the difference between an asset sale and a stock sale. So you're selling all of your equipment, receivables, payables, whatever it is, versus here's the stock of the company, and you're going to be the owner of the stock. Typically, a buyer wants an asset sale because they get to write off that equipment. The only exception that I've come across is if the company has customer contracts that are not transferable, so that maybe the buyer would then want a stock deal. But not to complicate things, you can elect to treat it as an asset sale. So please talk to your CPA when you start getting to this point, because you don't want to sign something and all of a sudden owe a bunch of tax. Speaking of that, on the seller side, the reason you want a stock sale is beneficial tax treatment. If you do asset sale and you've written off all your equipment, you have a bunch of ordinary income to pick up in year one. So you really need to be aware of how the different structures impact you on that. And even deciding, are you comfortable being a seller financed, or do you want the buyer to pay you up front? Maybe the company gets some bank financing. And once you've determined kind of the terms of the agreement, what you think the financing should be, it's good to do a cash flow feasibility to make sure that the income stream from the company can afford to pay you or the bank the amounts related to this transaction. And that's something that Julie or myself can help with. And also, once you kind of get over that hurdle, seeing after tax to you being the seller, are you getting enough cash flow for whatever it is you want to do after this transaction is over? Which kind of moves on to the next point, Julie, life after business planning.
Mm-hmm. There's so much to life after business planning. We just threw a few bullets on each slide just to kind of talk them through. But again, super high level content today. Hopefully we've generated some questions that you'd like to ask. We're going to leave plenty of time for that. But when it comes to life after business or next act planning, that's kind of what I like to call it. Let's just suffice it to say that it's the most overlooked part of exit planning. And how I know that is survey after survey has shown that sellers regretted the decision to sell. In fact, there was a survey done a few years ago. Pepperdine, I believe, did it, Pepperdine University. They do a lot of research. So if you're looking for good research on business ownership and statistics across the country, not just for entrepreneurism, but like industry specific, company size, all those kinds of things, you can pretty much find anything on their website, and it's all free. Anyway, one of the statistics that they found when they polled these sellers of companies after the fact and asked them how satisfied they were with their decision to sell. And they not only regretted, 78% regretted, they profoundly regretted the decision to sell. 78%. It's a huge number. Why? Why so many? Well, I think that I've got a couple of ideas on why, and one of them has to do with the fact that the vast majority had no plan. They had no next act plan. Many of them did not have a good relationship with a financial advisor, so they were not able to maintain the lifestyle that they thought they could because they didn't talk to people like Kyla. They didn't talk to people like whoever it is that's helping them on their wealth management side to make sure that they were able to do that, and that they weren't going to pay excess money in taxes that wasn't necessary. You know, all the things that Kyla's talking about in terms of, you know, the look back. You know, you want to make sure that you make those decisions well in advance, not you know, within 12 months of a sale usually. And then there's the whole conversation about relevance and productivity. You know, many entrepreneurs really identify who they are as people with their business. So if the business is no longer around and they no longer own it, and they don't have to set the alarm to get up, then what do they have to get up for? So you want to make sure that you think about that. Like, how am I going to spend my time? Another reason why they profoundly regret it, I'm sure, is that they had experienced a bad earnout situation. So we talked before about risk mitigation. One of those things is making sure that you have really good advice on structuring a really good earnout that's not one-sided, that makes sure that it addresses everything that's necessary. People like Kyla can help you with that, and your M&A attorney can help you with that. But you want to make sure that you have that well in advance, figured that out. One thing you can do, though, to prepare yourself for that next act is to just start journaling. Take some time for reflection. Talk to the people that you know. Make a list of the things that you absolutely must have, right? What are my non-negotiables? Like, if I'm going to sell it in a few years, and everybody's going to exit, by the way, you're either going to exit on your own terms or you're going to exit on somebody else's, but you will exit your business. So how that happens and how well it happens is totally up to you. But you want to make sure that you get what you want, because you worked really hard. You've sacrificed a lot. You've had some sleepless nights, maybe more than your share lately. So what do you really want? What do you want at the end of the day? Do you want to stay engaged in the business, but you just don't want the day-to-day anymore? I actually have a couple clients that are working towards that right now. They don't want to sell the business altogether because they love their work. They love what they do. But they just don't want to have all the pressure and the liability of the day-to-day. They want to go back to some of the things that they were doing when they first started, the things that they love to do. Maybe what you loved to do was business development work. Maybe you love, you know, expanding your account base or selling, or maybe you want to mentor. Maybe you want to consult for other people in your industry that are trying to get off the ground, and you've learned a lot and you have a lot to share. So really think about those things, right? Entrepreneurs don't sit in a rocking chair and knit. They just don't. You know, we're trailblazers, and we like to keep busy and we like to be productive. So how does that look? How does that look? When it comes to the deal, and say, for instance, you get a knock on the door, right? You get a phone call, and it's a legitimate one. Trust me, there's a lot of them that aren't legitimate. So don't talk to anybody before you've actually gotten good advisory and people that are supporting you and representing you. But you can get legitimate calls. And here's an example. I had a client from a year ago that got a legitimate call, and we had just started working together on transition planning, and they thought that they were going to sell internally. They had a management team that was interested in buying the company. They had a son in the business. We were working on succession and leadership development, and it was going to be great because they really wanted to leave a legacy for the business. They just wanted to spend more time at the lake and travel more and not be involved in the day-to-day, but they were willing to be engaged for a little while. Well, then when this large publicly held company knocked on their door and was interested in acquiring their business because they were doing industry consolidation, all of a sudden the game kind of changed, and we started really thinking about, well, could this be a good viable option? Well, it turns out, fast forward, it was. The deal was a great deal. They got a cash deal. This doesn't happen very often, okay? But what we determined together for their non-negotiables was that they wouldn't want to stay with the company for more than a year, so 1 year maximum. They decided what their new roles would be. We're talking husband and wife who own the company. They wanted an employment agreement for their son so that he would be gainfully employed after they were gone. And they wanted their cell phone covered and their health insurance covered for that year. And they got it all. So we got to think about those things, right? What is it that we want to have the new owner pick up if we end up going external?
Yeah.
And I think we got one more slide here.
Yep.
So keys to a smooth transaction. Well, let's just say that this is probably going to be the biggest financial transaction of your life. And most business owners only have one shot. You may have more than one. Maybe you'll sell a portion of it to an ESOP and you'll retain a large portion and do the rest later. Maybe you'll sell to a private equity firm and retain some ownership and have a second bite of the apple later. But by and large, most smaller privately held companies are going to have one shot. And you don't want to do it alone. But you're probably asking yourself right now, holy crow, this is going to be expensive. All these advisors, are you kidding me right now? Those are the obstacles that I hear. Those are the objections that I hear. And you're totally right. It's going to be super expensive. But it's going to be way more expensive if you don't have help. Way more. And if you start now, then you can eat the elephant a bite at a time in manageable pieces, working with the most important ones to help you get your business ready, help get you ready, and then you bring in the other advisors as you need them, as we figure out what's next. What path are we going to take? So that you don't leave money on the table and so that you can exit on your own terms and not somebody else's. We don't want you to be one of those that profoundly regrets. Do we, Kyla?
No, no. And I think the more you think about it, when that random opportunity could appear, that you're comfortable, that it matches your goals and can move and act quickly if you need to. And, you know, this last point, plans evolve, and that's okay. That's for me, because I'm an accountant. If I write it down, I feel like, okay, that's my plan. You got to be flexible because you never know where things take you, and just being comfortable with that.
Totally true, especially now because things are changing so rapidly, but we still have to have a plan. It's like we can't get in the car and start driving around and not know where we're going. You know, even if we run into a roadblock and we have to take a detour, we still know where we're going. We're just going in a different way. We're just taking a different path to get there. So yeah, I always say that if you have a plan and it's changing, it's because you're working it. Right.
Well, with that, if anybody has some questions, I have one that's come in about how I figure out a timeline for my exit. Julie, do you want to take that one?
Sure. I think that determining a timeline is going to start with you asking yourself, asking your shareholders, whoever it is that you own the business with, what do you really need? What do you really want? I have found in partnership situations where partners aren't having these conversations. They're not having conversations about what their own timeline is, what their wishes are. You know, one wants external sale, one wants internal sale. One wants to die with their boots on, one wants to get out in 4 to 5 years. You don't have to want the same things, but you definitely need to be talking about them. And so I think talking about what you need and what you want, just getting the conversation started, and then determining if you have a value gap. Because if you have a value gap and you really need that nest egg that you thought you had that you no longer have, then that's going to be part of your timeline, because closing the value gap is going to take time. In fact, that business readiness piece is what takes the most time in exit planning. And another part of timeline determination is if you have a family business and you've got a family member that you want to groom to take over, first of all, you have to have a conversation with them, make sure that they're interested. And secondly, you need to have a conversation about whether they're qualified. And if you've determined that both answers are yes, then you have to figure out how you're going to put that succession plan together. You know, start by working on family governance, setting some rules, figuring out, you know, how long is it going to take for this person to be able to take over some of the leadership responsibilities. So that's all part of the timeline, the value gap, leadership development, like I said, and then working with outside advisors to help you, because you gotta keep your foot on the gas. You don't want to try to do this all yourself.
Yeah, and there's so many aspects, as you can see from this short seminar, that you just can't know it all. You just have to build a team that you're comfortable with. And, you know, I see my job as giving you information so you can make informed decisions.
Exactly. And that's how Kyla and I work together, by the way. You know, Kyla does work that I don't do, and I do work that she doesn't do. But together, like she said, working with advisors from different disciplines, we don't have all the answers, just one of us singly, but together, collectively, we get pretty close.
Mm-hmm. Mm-hmm. And we have another question that came in here. Mm-hmm. Is separating real estate from the business sale a common practice? Are there advantages to doing so? Oh, Mike. It is typical to have them be separate components of the same transaction. Most real estate entities are an LLC, and that has different tax rules related to it. But if you sell them both at the same time, we just look through the agreements and sell them both. And the thing that you need to think about there is, if you sell the company and not the building, do you want to be their landlord? Are you comfortable with that? I think that's the biggest piece, in my opinion. But I think typically you just want to get out of the whole thing.
Sometimes, though, retaining the real estate is a way for them to be able to maintain their lifestyle if they've got that rent check coming in. I think it depends on where they're at financially, but yeah, definitely a separate transaction.
Mm-hmm. Mm-hmm.
So,
just one more question here, Julie. Okay. If I have children in the business, how do I know if they are good candidates to take over for me?
Well, that's a really good question. I'm going through the throes of that with a couple of my clients right now. One in particular that has a son and a daughter in the business. And so we've determined that they are interested in working for the business long-term and taking over. And that might sound like a small step, but really it's a big step. Many family businesses don't actually have that conversation. The first generation or whoever started the business, or whoever the founder is, just assumes that they want it, but they don't always want it, and they're not always qualified. So qualifying, how do we know? Well, look at it from a leadership development standpoint. First of all, does the family member or family members, do they actually have capability of being able to lead? And if you're the parents, then you probably have a good idea of whether they can or can't. And if you're not sure, then use the outside advice of an advisor who can help you figure that out. There's a lot of leadership development advisors out there who can do some assessments and help you figure out where the strengths are of the people who are on your team, not just your family members who might take over, but also your key people. You know, it's all about having the right people in the right seats, and that's key right now. And so leadership development, having candid conversations, and then figuring out basically, if this is going to be a family business, should we put some governance in place? Should we make some decisions about how long someone has to be working elsewhere before they can come into the business for future generations? How old do they have to be before they could be a shareholder? And how do they buy in? Are we willing to gift or not? And do they start at the bottom and work their way up? I think that there's a lot to be said for starting at the bottom and working their way up, because it lends credibility with non-family members who are already in the business, who've been there for a long time. Bringing in a child and having them paid a nice six-figure salary, and all of a sudden putting them as overseers of people who've been there for a long time can kind of lead to some dissension. So you want to be really careful about that. And you want to eliminate entitlement as much as you can. So have candid conversations, figure out whether they can lead or not lead, and then figure out how you're going to do this. If it's going to be incremental, which could make sense, then maybe it's a gradual passing of the baton, if you will.
I think we have time for one more question, it looks like, Julie.
Okay.
What are some growth strategies you've seen companies implement?
Well, there's one that kind of closes the gap pretty quick, and that would be acquisition. And let's face it, there are millions of privately held companies that need to transition. This is really getting to be an economic concern for the entire country, because so many need to transition at the same time. And most of them will not transition well because they're not prepared or because they're too small, and acquiring them is only for, you know, certain companies that might be interested in acquiring a list or something like that. So, but if you find yourself in a position where you've got, you know, money's cheap right now, so you can borrow money pretty easily and buy a smaller company. I've had a couple clients that have actually done that, and they have acquired smaller businesses which were good strategic purchases that actually complemented what they were already doing. One of them was an online business that manufactures and sells. They've got 17 patents in digestive health products. They sell them all over the world. And they had 1 or 2 enzyme products, but not very many. Most of them were probiotics and fiber. And so what they did was they acquired a company that specialized in numerous enzyme formulations and had, you know, the same standards of quality and IP that was protected. And so they bought that company, and it's just been a super good move. So that's just one example of how you can grow. Another, of course, is just focusing on sales, focusing on low-hanging fruit. Okay, how can we do more cross-selling? What is it that we already have, you know, in the hopper in terms of customers and clients and services that they're not already taking advantage of that we could be selling them?
Mm-hmm. Yeah, and right now with you know, everything going on in the world out there, I've had clients look back to some of those lost opportunities and just reach out and see how things are going, see if maybe they want to revisit using your service, whatever your product is. I've had some clients be successful with that as well.
Well, one more thing when it comes to growth, and I've got a couple clients actually that are doing this as well, and that is adding on a new product or a new service. And I'm not talking about reinventing a wheel at all. We're going back to that low-hanging fruit concept, and here's what that looks like. So one of them is in the exteriors business, and their focus is on multi-housing complexes and commercial buildings. And so one of the service add-ons that they want to be able to market, and they're going to, because they already have the crews, you know, they already have the knowledge and expertise, is to add on a service for doing build outs and tenant improvements in commercial property over the winter, because the winter is when they're usually laying people off and they're not quite sure what to expect next year. And so they can easily move into that as a service offering, very easily, you know, building it out, of course, in their accounting and putting in, you know, a process together in terms of bringing in, you know, new clients, new customers. But, you know, think of those kinds of things, of different ways that you could expand on what you're already doing with what you already have. Another is steel fabrication and or steel erection company, and they are going to start rebarring. And they already have the ingenuity, they already have the equipment, they already have the crews. So anyway, a couple ideas for growth.
Yeah, thanks, Julie. And everyone, you know, thanks for joining us. Please follow JAK on LinkedIn, Keys Strategies. Connect with me and Julie. We're pushing out content. I'm here to help if any of you have questions, help guide you towards the accounting answer or a professional that can help you as well. JAK has one more lunch and learn before tax season starts, and PPP, forgiveness and taxes, all that fun stuff that we didn't know anything about a year ago. Just kind of recap on that. And you know, Julie, she wrote a book within the last year, Poised for Exit. So look out on Amazon. I think that's also available at Barnes and Noble. And she has some great podcasts. Are you doing those weekly or is that monthly?
Every week.
Every week. Okay. That are available for free download out there. I found that to be really good content for when I'm in the car, when you're in the car these days, or just working, listening to in the background. Some great speakers and information.
Thank you. And Kyla, I'm looking forward to having you on the show coming up here in the first quarter of 2021.
Yeah, that's right.
So, yeah, that'll be great.
All right. Well, thank you, everyone. Within a couple days, we'll send out the slide deck and a recording if you want to refer back to it or share it with anybody else. Feel free. I hope you picked up some good tidbits today and have a good rest of your day. Thank you.
Bye, everybody. Thank you.